time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
So Converge Technology Solutions, CTS on the TSX, currently trading at a price of about $3.44, a market cap of about $716 million, and a forward dividend yield of about 1.2%. They just initiated a dividend here. So description on the company. So Converge Technology Solutions Corp is a software-enabled IT and cloud solution value-added reseller focused on delivering industry-leading solutions and services. So Converge's global solution approach delivers advanced analytics, application modernization, cloud, cybersecurity, digital infrastructure, and digital workplace offerings to clients across various industries. And the company supports these solutions with advisory, implementation, and managed services across all major IT vendors in the marketplace. So like Ryan said, we have covered Converge a couple times on the podcast. The first time was in October of 2020. You can see on the screen here. And at that time, the stock traded with an enterprise value to EBITDA multiple of 3 times. It had trailing 12-month adjusted EBITDA margins of about 5%, net debt of about $207 million, and a net debt to EBITDA multiple of 5 times, which is pretty high, and shares outstanding of about 122 million. Now, the second time that we covered it was in March of 2022. And at that time, the stock traded with an EV to EBITDA multiple of 22 times, an adjusted EBITDA margin of about 7%. They now moved to a net cash position of about 229 million, and the shares outstanding had almost doubled to 215 million. And both times, my conclusion when I covered the stock was that it had great growth driven by acquisitions. That's top line growth, which was funded by both debt and equity dilution. But the stock had very thin margins. And I noted that several, and I actually got this from Ryan just due to his experience in the industry, that several of Converge's executives were originally from the publicly traded company Pivot Technology Solutions, which was PTG on the TSX, which was in the similar IT solutions industry as Converge. But in the case of Pivot, we saw management rapidly grow the top line of the business through acquisitions with the use of financial leverage. However, the company was unable to establish accretive acquisitions and generate per share cash flow for shareholders over time, which led to a dismal share price. So moving on, just quickly here, I'll show you where their locations are. When I covered them, I do not believe that they were quite in Europe yet. They were just North America, but now they are in Europe as well. And a few company updates here. So in late 2022, November to be exact, the board of directors announced a strategic review process to evaluate a full range of strategic alternatives, including a sale, merger, divestiture, recapitalization, and another strategic transaction, or continuing to operate as a public company. However, on May 9th, just recently, the company concluded the process and indicated that it will continue as a public company and continue to execute on its business plan. Now, like I said at the beginning, recently the board of directors authorized the initiation of a quarterly dividend of 1 cent per share, and they also intend to resume purchases under its NCIB that commenced last summer. Now, in the company's Q1 2023 conference call, management indicated that after acquiring approximately $1.2 billion of gross sales through 10 acquisitions last year, they are pausing to focus on integration, cross-selling, and cash generation. And keep in mind, this isn't net sales, which is actually going to the business. They're referencing gross sales there. So essentially, the company has decided right now to prioritize organic growth over acquisitions in the short term, and to continue to gain efficiencies through integration of its past acquisitions, which really we have only really seen the company continue to aggressively acquire in the past. Now, looking at the recent financial results for Q1 of 2023, net revenues were up 37% to $678.2 million. Dollar terms, organic growth was about 6.8% year over year. Adjusted EBITDA increased about 39% to 41.2 million, and that's an adjusted EBITDA margin of about 6%. Adjusted EPS was up 20% to 12 cents per share compared to the same period last year. We will dig into those adjusted numbers pretty soon here. And the company now has net debt of about 321 million and a trailing net debt to EBITDA multiple of 2.1 times. And they are paying variable interest on that debt. And as at the last quarter, their interest rate was 5.1%. And the outstanding balance, I believe, is about 460 million Canadian. And then finally, the stock trades right now with an enterprise value to EBITDA multiple of about 6.7 times. So let's quickly look at how the company is adjusting its net income to get to adjusted net income. Now, you can see that every quarter, the company is adding back significant special charges here. And if we look to see what those special charges consist of, the company provides a definition of special charges consist primarily of restructuring related expenses for employee terminations, lease terminations, restructuring of acquired companies, as well as certain legal fees or provisions related to acquired companies. Now, personally, I think that adding these special charges back may be a little suspect, as the company is consistently making acquisitions and continuing to incur these costs. So, I don't know if we can really take the adjusted figures that they're providing here, but that's just my opinion. I'll get Ryan and Aaron and Brett's opinions after. Now, finally, to conclude here, revenue growth has been tremendous, driven by an aggressive cadence of acquisitions, but in the near term, management plans to slow down on acquisitions and focus on integration. Essentially, we have seen the company go from significant net debt to then issuing shares to improve the balance sheet and get back into a net cash position. But now the company is back into a significant net debt position again, now with debt of about 460 million as at March 31st, 2023, and a net debt to EBITDA multiple of about 2.1 times. And again, it pays interest at a variable rate on this debt. Now, the company trades with an EV to EBITDA multiple just under 7 times, but adjusted EBITDA margins and net profit margins continue to be very thin. And as I indicated, the adjustments that the company is making to get to its adjusted profitability are a little suspect, at least in my opinion. Now, Converge continues to be a company which we monitor, but not a name we would recommend to our clients. And I will open it up to the gentlemen to see if they have any comments.
Yeah, I mean, just generally speaking, software resellers, low margin business. The plan for CTS has been to continue to increase the margin profile over time, the EBITDA margin. We just haven't seen that really play out in real time. And, unless you can see that play out, I mean, there is a managed services part of the business. They want to get that part, I believe, to the range of 25% adjusted or EBITDA margin. They think when originally it was they thought at $1 billion of managed services revenue, they could get to that type of margin. I think right now, like on an annual basis, they're doing like 130 million or something like that, in that range. Don't quote me on that, but I believe that's what I read. They're nowhere near that. And that would help the margin profile overall. But when you're doing in the billions of sales that they're doing now, but it's still a small portion of that revenue is managed services, they just haven't been able to pull up the margin profile of the business. And we need to see them hit on that over time. I've seen brokerage out there continually recommend this stock, continually have a higher margin expectation for the company, and the company just not hit it. And that's why you see the share price continue to go lower in the market. You've flipped from a massive cash position to a significant net debt position. I think the net debt is around 316 million as at the last quarter. Total debt is like 447 million. High debt level for a company with this market cap. Within an increasing rate environment, in a low margin business, that cuts into your margins, your cash flow margins over time. And it's not something that we are looking at when it's, making it still trades at, on a GAAP basis, a high multiple, despite the tremendous drop in the company's share price.
Mm-hmm.
It's just not something that we like. We like a higher margin, better business with, that can actually push more of that growth on the top line to the bottom line.
Exactly. And even if we,
something to watch here is organic growth going forward as well.
And even if we look at, the GAAP EPS, say in, Q3 of 2022, where it looks like it's, earning 10 cents per share. I mean, realistically, that was primarily from FX, foreign exchange gain, so
not even primarily, just basically,
yeah, 100%. That's what it was.
Just,
so
no, that's what you're saying.
Yes. Yeah, exactly. So, how can a company like this attract a high multiple if, we're seeing margins like this? And I think Ryan already said that, but,
and the sad thing is, the reason you see so many brokerages, boutique and larger brokerages in Canada continue to recommend this company is because they wet their whistle on a company like this. It keeps doing financings. They keep making the brokerages money that way. People that they're selling shares to or selling their research to that are buying this company. It's not the worst company out there. It's certainly, that's not what we're saying, but it hasn't produced the margin improvement story that we, that the company has promised. And, that's led to a lower share price over time. And there is razor thin margins, and you have now more debt. We just went over this, shrinking profit margins, share price goes down. Not a lot in the kitty to make more acquisitions. I mean, they talked about a strategy of now cross-selling. Well, I'm not sure where the capital is going to come from for them to actually go out there and make acquisitions. I mean, again, there is cash sitting there, but then you just go more and more into debt.
Yeah,
you could raise shares and you dilute more. So
just to give a quick idea about brokerages recommending this stock, they display 13 price targets on their website. Guess how many of them are below the current price of about $3.30, and guess how many are above?
I'd say all are.
They're
above.
all above. Yeah.
Yeah, one below. So
wow,
one below. CIBC recommends at a price target of $3, and the rest are $4.50 or higher. Most are about $7. So all the major banks like CIBC, Cormark, they're all recommending it, and this is on Converge's website. Of course, this is why it's just
the thing is, it's been a top pick of I'm not going to name, but of several like boutique brokerages, and it certainly hasn't done well. Again, there are revenues here. There is some level of profitability at times. It's not the worst company that we're talking about out there, but when we see companies that actually have better margins, more consistent growth, these are the type of companies we like to invest in. Yes, this company has implemented a dividend, but there's a massive amount of debt here. Maybe you just want to pay off some of that debt instead of paying back a dividend until it's incredibly sustainable.
And one last point, I actually found what they were targeting here. So this was in one of their past presentations. So long term, the company is aiming to grow its revenue from 2 to 5 billion through 2022 to the end of 2025, and grow its adjusted EBITDA margins to 10% by 2025. So they're looking to grow those margins. Who knows
that would be probably by onboarding more managed services revenues, which they think they can get the higher margin from, which they likely can. They got to do it. They haven't been able to so far, and until they can, they're not going to get to those multiples. And even at 10%, it's just okay, right? It's like there's many companies we're looking at with 20 plus percent that are just more interest to us that we'd look at. It's not not the worst company out there. We're looking for better companies with better margins over the long term.